Hi traders, it's Memorial Day here in the US, bank holiday in London. This is Dale Pinkert. My Twitter handle is at Forex Stop Hunter. Also my birthday. So glad to be here to share some views going into the week ahead. Keep in mind it's the end of the month-end flows or cross currents in the markets. Start off with the 4-hour look at US dollar yen. We've retested that 109 support level trying to bounce here. Should we be able to penetrate 109.90, then there's still potential for 110.80, and I would assume that would mean risk on during that time period. If we have one more flush in S&Ps down to 2780 or so, it looks like the yen still my target, regardless of the short-term path, is still lower. 109 is not the low, in my opinion. In my very accurate and humble opinion, I still think we'll see that red line underneath the market that I showed at 108 before we have the completion of this and perhaps longer-term, intermediate-term buys in U.S. dollar yen. So looking for rallies still to sell in U.S. dollar yen. Again, last week I talked about the reversal in the Dixie. So after you have a reversal, the market has to prove that it's real. We did close under the 97.80 pivot point that I had mentioned last week. I have a 2-week off number up around the 98 level, in between 61.8 and halfway back, thinking there might be a test of that early in the week. I would not like to see the market closing back above 98.06. That would mean that there's still a third drive coming. But I have to go with what happened last week. I was there for it on the first red candle at the highs before we closed and took profits on Friday. So looking to take advantage of any early week dollar strength to sell into, similar to what's happening in the yen. And then I wanted to draw everyone's attention to something that I think is fairly important for a few different ways. And with that, I displayed the 30-year daily, 30-year yield chart. So the 30-year yield chart daily, you can see that we're almost at a 3 drive to a bottom formation. The form is there, the RSI divergence is there. Still don't believe that it's the right time. Short term, long term, I would be seller of bonds. Remember, I was talking about the 10-year yield possibly going towards that 220 level. So we're still 12 bips away from that 220 level. I know for people even looking for lower numbers around the 210 level. But from a macro basis, I think this is going to set up at least a trading opportunity on the short term of getting out of TLT, which is the ETF 20-year Treasury ETF, on the long side of bonds, and shortly within the next couple weeks, looking at TBT, which takes advantage of rates and yields beginning to rise. What's also interesting is the bond chart is the 30-year is much closer to completion than the 10, which tells me that although everyone's talking about the inversion of the curve, if the chart is correct, we may end up with this next rate rise, the short end staying lower and the long end yields rising to steepen the curve. Good hunting this week. This is Dale Pinkert. Don't just count your pips, count your blessings. I thank the troops that saved freedom for everybody, and I know where your stops are. Adios. Forex Stop Hunter.